a stock most professional analysts on Wall Street cannot locate on a map, just moved 15.7% in a single session on volume that was multiples of its daily average. That is not noise. That is a signal. Freedom Holding Corp, ticker FRHC, operates brokerage, banking, and insurance services across Central Asia and Eastern Europe. And as of July 1st, 2026, the market repriced it dramatically in a matter of hours. The question that actually matters is not what happened. It's whether the move reflects new information or just momentum chasing liquidity. By the end of this video, you'll know how to tell the difference. Let's start with the mechanism, because a 16% move doesn't happen in a vacuum. Freedom Holding Corp is not a household name in New York or London, but that's structurally intentional. The company, headquartered in Almaty, Kazakhstan, and listed on NASDAQ, operates under a model that is genuinely unusual for a U.S.-listed equity. It generates the majority of its revenue from brokerage commissions, margin lending, and increasingly from insurance premiums across markets that most Western capital has structurally avoided since 2022. That geographic concentration is both the risk and the opportunity. On July 1st, 2026, the catalyst triggering this move appears rooted in one of a few recurring patterns that reliably produce these single-day repricing events. The most common is an earnings surprise or a forward guidance revision that the consensus had not priced in. FRHC has a history of reporting results that diverge meaningfully from analyst estimates precisely because coverage of the company is thin. Fewer than a handful of sell-side analysts actively model the stock. When coverage is sparse, the estimate distribution is wide, and earnings beats land harder. The second possible catalyst class is a strategic announcement, an acquisition, a new market license, or a partnership that expands the addressable revenue base. In emerging market financial services, a single regulatory approval to operate in a new country can add meaningful revenue at high incremental margins. The third catalyst class is macro-driven, a shift in the geopolitical or currency environment affecting the company's core operating regions can revalue the entire earnings stream overnight. Any combination of these factors arriving simultaneously creates the kind of volume and price action we saw today. What matters for your analytical process is identifying which category this belongs to before you make any capital allocation decision. Misidentifying a macro tailwind as a fundamental catalyst is one of the most expensive mistakes you can make in this kind of stock. Here is where most retail coverage goes completely wrong. They report the percentage move and call it a story. The actual question is whether the new market capitalization is defensible given what the business generates. Let's work through this with the discipline this audience expects. Freedom Holding has grown its revenue base aggressively over the past several fiscal years, expanding from a pure play Central Asian brokerage into a diversified financial services group with meaningful insurance and banking operations. That diversification matters for valuation because it shifts the multiple conversation from transaction volume-dependent brokerage earnings, which are notoriously cyclical, toward more recurring revenue streams that warrant higher price to earnings ratios. Here's the framework. A regional brokerage trading in isolation might reasonably command a 10 to 14 times earnings multiple. A diversified financial services platform with insurance float and balance sheet lending, growing in underpenetrated markets with expanding middle classes, can justify 18 to 22 times earnings if the growth rate supports it. The critical variable is whether this 15.7% move pushed FRHC's multiple into the second category's range or beyond it. After a move of this magnitude, you need to do one specific calculation immediately. Divide the new market cap by trailing 12-month net income and then divide it again by forward earnings if you have access to updated consensus. If the resulting multiple is above the high end of the defensible range for the business type, the market has either received information you haven't fully processed yet, or momentum has temporarily overpowered fundamentals. Neither scenario is inherently a buy signal or a sell signal. They are diagnostically different situations, requiring different responses. Chasing price. When momentum is the driver means you are the exit liquidity for whoever entered earlier. Dismissing a genuine fundamental re-rating because the move feels too fast is equally costly. It is how investors miss the first 20% of a legitimate multi-year re-rating. And this is not financial advice. Your specific situation, risk tolerance, and position sizing constraints determine what the right action is for you, not a price chart alone. If you are still building your analytical framework, this kind of event is one of the most instructive classrooms the market will ever offer you, provided you study it correctly, rather than just watching the ticker. The first principle is that volume tells you the quality of the move. A 16% gain on 1.2 times average volume is a very different event from a 16% gain on 4 or 5 times average volume. Higher relative volume means more participants are involved, more institutions making sizing decisions, more algorithmic systems repricing correlated positions. It raises the probability that real information is being acted on rather than a thin market gap being filled by retail momentum. When FRHC moved today, the volume profile is one of the first things you verify because it distinguishes a signal from noise. The second principle is the 48-hour rule for catalyst assessment. In the first hours after a major move, information is incomplete. Press releases get misread. Headlines get stripped of context. The traders who lose money most consistently in catalyst events are the ones making decisions inside that first 48-hour window without having read the primary source document, the actual earnings release, the actual 8K filing, the actual regulatory announcement. If you cannot identify and read the primary source, you are trading on a summary of a summary, and someone downstream of the original information has already taken their profit at your expense. The third principle is position sizing discipline in the aftermath of a move. If your analysis concludes the move is justified and there's further upside, the entry price has changed materially. The risk-reward calculation that existed yesterday no longer exists. A position size that was appropriate at the pre-move price may carry double the downside risk at the post-move price if the catalyst narrative partially unwinds, which happens with meaningful frequency in thinly covered, geographically concentrated stocks like FRHC. Freedom Holding is a legitimate, growing financial services business. It's also a company where information asymmetry between institutional specialists and generalist retail investors is structurally large. The investors who navigate that asymmetry successfully are not the ones who react fastest. They're the ones who verify before they commit. We opened with a question. Is a 15.7% single-day move in Freedom Holding Corp price discovery or price dislocation? The honest answer, it depends on which of the 3 catalyst categories drove it. Whether the post-move multiple remains within the defensible range for the business, and what the volume profile told you about institutional conviction. 1 move, 3 separate diagnostic questions. That is how this works. Next, we are going to examine what happens to stocks like FRHC in the 30 days following a catalyst spike. The pattern may surprise you. Subscribe so you don't miss it.